Hello and welcome back. In this video we're going to talk about Alibaba and Chinese stocks and what they are doing today. And of course I do have my own opinions about the pandemic and whatever has happened really. I don't want to get political nor have my videos pulled down for for no reason, but I will say that the situation is getting more and more ridiculous by the day, and I couldn't even fathom how this could be the case. But everyday news tend to surprise me more and more. Now we're going to be taking a look at why Alibaba and other major stocks are sliding today, and I have opened up an article here that kind of discusses the situation right now, and you will see that we are potentially expecting a decrease, a drop in terms of stock price for Alibaba today of about 3% is what is actually happening right now in Hong Kong. So I wouldn't be surprised if it's actually a little bit more. The US tends to overreact in situations of that sort. So I may expect to see a movement of 5%, maybe down or so. I suppose maybe that's the case. And that potentially opens up for even more buying for people who haven't actually added Alibaba to their portfolio and they are willing to, or other companies of that in that sense, similar companies that are doing fairly well, like Tencent or Baidu or JD.com, are all companies that are pretty cheap right now, and they are definitely worth a look. Now, what is very, very interesting here is the reasons why this is happening right now. As the article mentions here, a couple of reasons. The fact that aluminum recession intensifies after the 10-year treasury yield has climbed, and there has been actually an inverse yield right now. And so this potentially signals for a recession, is one of the strong signals actually. And I will probably make a separate video about it, just talk about inverted yields and what do they mean for the economy. But basically it's about people who are in the bond market being willing to take more risk in the long term than actually the short term. And this sometimes can point to a recession-like environment, and it tends to actually happen many times, if the majority of times really. We're gonna talk a little bit about it. And other things here, very interesting stuff. The fact that Shanghai residents are actually screaming in frustration from their balconies as the COVID lockdown enters its third week. I actually saw a video about this. I wasn't aware if that's real, but it did look scary. Okay, so we're gonna be taking a little bit of a look, and we'll see here that Shanghai enters lockdown week 3, pretty much, and there are concerns over access to food. That's weird. Now you will see that there have so far been about 1,000 confirmed cases in a city with a population of 26 million people. So it makes total sense that they lock down everybody. And the US government is advising Americans to avoid travel to China right now because of arbitrary enforcement of restrictions and the potential of parents and children being separated and all that. So this definitely doesn't really help in terms of the stock market environment, as you can understand, of course. And it definitely has a massive impact. The residents not even being allowed to leave their buildings. They're basically locked for good for no real reason, really. And so, yeah, the Chinese government is actually said that they're reporting that essential daily supplies have been secured. I don't know how. Maybe they're going to send in drones or something, who knows. So the next thing, which is important and also plays a role in this kind of environment, and could actually trigger some potential prices going down for a while, and even maybe a recession really, is the inversion of the U.S. bond yields, as you'll see. You can kind of see it here. That's the U.S. 10-year bonds versus the U.S. 2-year bonds really, and as you'll see over here, it has actually flipped, and the 2-year yield rose to 2.45, while the 10-year hiked to 2.432. And this is, as I mentioned earlier, this can be a bad sign because investors tend to actually take more risk for the long term than the short term. So they think that in the short term things are going to be bad, and this typically tends to be a recession signal. It has happened many times, and few times has actually been rejected and hasn't really happened to be the case. For instance, in on 2019, if you remember, if you were watching these things, there was a brief surpass of the yield for its 10-year counterpart. As you'll see, it actually surpassed the 2-year. And this predicted, kind of predated the 2-month recession, sort of, if you can call it that. It was like a 2-month steep decline. I would mostly say it wasn't really a recession. But yeah, this tends to be an indicator that is very, very important and pretty reliable here. You'll see, according to a 2018 report, each recession since 1955 followed the inversion of the US yield curve between 6 and 24 months. And the only time this hasn't happened was a false positive in the mid 1960s. So you need to definitely pay attention to this one and take it into account when you are investing in the stock market. And I wouldn't be surprised if this actually becomes even a steeper inversion at some point because of the rising interest rates. So increasing yields of short-term US government debt reflect expectations of a series of rate hikes by the Fed. And they do have to do that. I mean, there's no other way, because with all the money they have printed and all the inflation that they have caused, they have to find a way to actually tame that. And what is the way? There's no other way really other than increasing interest rates. And so they have to, kind of artificially freeze the economy for a little while in order to bring down the rates. And as you can understand, this was again caused by all the supposed measures that were taken for the pandemic. This definitely has its impact in the long run, that's for sure. And this is why it's very, very important, especially right now, to avoid companies and stocks that are speculative, because I wouldn't be surprised if some of those go to zero or very close to that, especially if a recession hits. But if you are holding companies that are strong, companies that have great cash flows, these kinds of companies like Facebook, for example, or Alibaba, I have talked about before, then you are in much better hands, because they have a lot of assets to go with. And they have they're actually making quite some money already. And so, if things can go bad and they have a little bit of a recession for a while, I'm pretty sure they will be able to sustain it without being too hurt, unless there is a very, very deep recession that will last for, I don't know, like 5 or 10 years, which is unlikely. They typically do last like a couple of years or so. But these kinds of companies that are overvalued and they have nothing to go with, they will go down, at least the majority of them. They will have deep, deep troubles, and it's very likely that you will see prices decline. So you have to be careful about owning these kinds of companies right now. And this is what I'm trying to actually talk about a lot in my channel. So today, yeah, you should probably expect some decline again in Alibaba and other Chinese stocks, as we're getting these kinds of news, and as China is basically on lockdown for whatever the reason is. So thank you for watching the video, and I hope you enjoyed. And please leave a like if you did, and remember to subscribe. And I'll see you in the next one. Bye bye.